Welcome to this explainer. Today, we're diving into the absolute most critical, high-stakes bottleneck in the entire world of financial crime. We usually imagine the crime itself, the grand heist, the massive fraud, as the big finale, right? But the reality? It's way more complicated. The true test for a criminal doesn't actually end when the illicit act is committed. It literally just begins the moment they try to make that dirty money usable. So, we're going to explore the exact mechanics of how illicit proceeds first breach the walls of the legitimate financial system.
Now, you might be wondering, what exactly is the most dangerous moment for a financial criminal? It's kind of a fascinating paradox. Pulling off the underlying crime, the fraud, the theft, the trafficking, that's often the easy part. The real danger, the exact moment where the whole operation risks total, catastrophic failure, is when they have to cross the border and actually deposit that illicit cash. Think about it. They're holding wealth, sure, but it's toxic wealth. It's completely useless to them in the real world until they can wash it. And that incredibly dangerous act of trying to shove dirty money into a clean bank account, that's exactly where they usually get caught.
Okay, let's dive into this. Section 1. The money laundering cycle. So to give us a macro view, the UNODC outlines a classic three-stage model for the complete journey of a dirty dollar. Step 1, placement. Step 2, layering, which is basically creating a crazy maze of complex transactions to confuse anyone tracking the money. And step 3, integration. That's bringing the money back to the criminal as quote-unquote legitimate income. You really have to complete all three stages to successfully launder money. But today, for us, we're hyper-focusing on just that very first one.
Moving on to Section 2, defining the placement phase, where we rapidly zoom in on this very first step.
Placement is essentially the messy bridge connecting the crime itself to the clean, legitimate economy. Before this stage, the criminal is holding literal duffel bags of toxic cash. They are intimately linked to the predicate offense, and the money is just incredibly difficult to use out in the open. The ultimate goal? Dump the bag, enter the system, and start reducing suspicion. Simply put, it's the initial entry of illicit proceeds into the financial system.
Section 3. The point of maximum exposure. Let's break this down like a heist.
So why do criminals sweat this stage so much? Well, because right now, at this exact moment, they are literally holding the smoking gun. From a professional anti-money laundering perspective, this is absolutely the most exposed stage of the entire process. They haven't had the chance to create those confusing audit trails yet. There are no fancy shell companies in the Cayman Islands protecting them. No, it's just them, a giant mountain of dirty money, and a highly suspicious bank teller. The UNODC actually perfectly validates this immense tension with institutional authority. They state, launderers are often most vulnerable here because large amounts of illicit cash can attract attention. And I mean, think about the sheer logistics of that for a second. Imagine trying to subtly deposit 50 grand in small, crumpled, suspicious-smelling bills. The physical nature of cash makes it an absolute nightmare. It's bulky, it's obvious, and walking it right into a financial institution instantly puts a giant target on your back.
Now, what's really interesting here is that before the audit trail gets scrambled, the original characteristics of the funds are glaringly visible. On the customer behavior side, financial institutions are actively watching for inconsistent behavior or actions that just have a weak economic rationale. Like, if a local mom-and-pop bakery suddenly deposits $1 million in completely unexplained cash, the math doesn't add up, right? Unless they're selling the world's most expensive cupcakes, it lacks commercial sense. Combine that with transaction anomalies like unusual cash volumes or totally unexplained deposits, and those red flags are flying high and clear.
All right, Section 4, Tactics of the Trade. Let's look at how they try to sneak past the guards.
So how do they actually pull it off? Well, there are direct cash deposits, structuring, which is breaking massive sums into tiny, under-the-radar drops, purchasing monetary instruments like money orders, funneling money through cash-intensive fronts, car washes or restaurants where tons of cash is totally expected, converting funds into other assets, or utilizing accounts that simply absorb value. The exact method shifts, but the underlying panic, that's exactly the same. It's a frantic scramble to desperately introduce illicit value into channels where it can be moved later.
Okay, let's slow things down a bit for Section 5, Detecting the Dirty Money.
What we have here is a fundamental conflict. Really, it's a battle of narratives. The launderer's goal is pure stress relief. Dump the illicit cash, blend in, and just reduce suspicion. But the bank's goal? They operate as a defensive tripwire, identify unusual volumes, and spot weak commercial logic. So the criminal is essentially trying to tell this convincing story of legitimate commerce, and the bank
is meticulously analyzing that exact story to see if the math actually adds up.
And how exactly does the bank test that story? Well, through anti-money laundering tripwires. It starts with customer due diligence, which is just actually knowing who you are and what your normal banking habits should look like. Then, cash controls physically monitor large sums. Transaction monitoring uses complex algorithms running in the background to catch those unexplained deposits or structured payments we talked about. And finally, suspicious activity escalation. Because if a bank really understands your expected behavior, these controls serve as the absolute best opportunity to interrupt the laundering process the very second incoming funds stop making commercial sense.
Now, a professionally mature view of financial crime definitely recognizes that these stages aren't perfectly rigid. They can absolutely overlap in the real world. But as the Financial Action Task Force points out, countries should consider threats at all 3 stages of money laundering, including placement. So even when things blur, treating placement as a distinct, hyper-focused frontline control is completely vital. It is the definitive moment when criminal proceeds first touch the legitimate financial system.
Which brings us to this. If we miss the placement stage, the trail completely goes dark. The original characteristics of the money vanish, it all blends into the system, and the criminal gains the ultimate advantage. Catching that first breach isn't just some administrative task. It genuinely remains our absolute greatest hope in interrupting and stopping financial crime. But as laundering tactics become increasingly digital and decentralized, are our traditional tripwires still going to be enough to catch the next generation of financial crime? Thank you so much for joining me for this explainer.